Hello, this is Jordan, and this video is being recorded on Friday, May 13th, 2022. Thank you so much for joining me today. Hope everyone had a good enough week despite the very troubling markets. And in this video, I'm going to try and provide some clarity and discuss when I think gold will turn. When is it going to go higher? I'm going to talk about the important things that we can watch over the days ahead that will help us decipher when gold should turn and when it really is turning. Now, we did see a rebound today, Friday, so maybe this is the start. I tend to think not, but I don't have a crystal ball, so we should always consider the other possibilities. But I got 3 or 4 slides here. First thing is financial conditions have been tightening. This is the Goldman Sachs Financial Conditions Index. And yes, this is kind of old. The black line in there is based on where I last saw the index, which is just below 99. That was a week or 10 days ago, so it's probably at 99, maybe a little bit higher. These financial conditions indices, they're not usually publicly available. They're probably available on Bloomberg. I mean, you can see some history on Google Images. The Econ Fred site, I forget the name of it, that has all that great data, the Federal Reserve Bank site, I think. You can find things on there. But anyway, the key takeaway here is if we look at the last 3 bottoms in precious metals, January 2016, or December 2015 to be exact, we look at summer 2018, and then the COVID bottom, 2 of those 3, you basically had precious metals bottoming when financial conditions stopped tightening. And with where we are here and now, where things are going, it's very possible that we could see a repeat, and it could be 3 out of 4. So watch financial conditions, and when they start to ease up, that is one signal, one major signal, I should say. And what do these financial conditions indices consist of? Well, I don't know how they're calculated, but they're based on the dollar, for example, credit spreads, the Fed funds rate, and even equity prices to some degree. So all those things go into these baskets, and so that gives us an idea of financial conditions. And yes, they'll probably continue to rise, but my view is at some point, sooner rather than later, they've risen enough where if they continue to rise a material degree, they're really going to start to inflict some damage. So I think the Fed is not ready to step in yet. There probably needs to be some more tightening of financial conditions, but can the system really allow that much more tightening? I don't think so. And so getting to the Fed cutting rates, I mean, I've been talking about this a lot recently. I also talked about this in 2018 in videos and articles. I wrote about it in my 2019 book, which I published, I think, in early 2019. And this data here shows basically how gold and gold stocks perform when the Fed stops hiking rates and then they go to rate cuts. And this was before that 2018-2019 cycle. And you'll see this in the next chart, but if we look at, you can look there that 1995, the time between the last hike and then the rate cut, I mean, that was only 5 months. You can see 1989, 2 months, 1 month. So if we look at the last, if we look at the last 7 Fed cycles or so, I mean, the 2000 and the mid-2000s one, those were really outliers. I mean, because the economy was in stronger shape during those points. So if we remove those, we're looking at really 1 or 2 months where the time between the last hike and then they went to the cut, that was pretty quick. If we look at the last cycle, the last hike was December 2018. Of course, gold stocks bottomed before then, but December 2018, and then May was when the Fed basically told the market, we're going to cut rates. And they did it in June or July, forget which month. But so you basically had a 5-month, it was only 5 months between the last hike and the market knew they were cutting rates. And again, if you look at, aside from the previous two cycles, if you look at the other ones there in the 80s and 90s, the Fed did an about face really quickly. So, I mean, even if the last Fed hike in this cycle, even if it's in July, I mean, you look at 5 months, you see what happened in the last cycle, and that repeats itself. The Fed would be cutting in December, and that's based on 5 months. In this cycle, with the way things are trending and how they're tightening financial conditions, whenever they reverse course, they're probably going to reverse course. It's probably going to be faster than 5 months this time around, I would think. I mean, who knows? Maybe they could tighten all the way to September, and then the next month they're cutting rates and completely reversing course. And so I tend to think that, if we're looking at history, what usually happens, and I'll get to the next chart, what usually happens is gold and gold stocks bottom around the time when the Fed does the last hike or soon after. They're shifting policy. And then when they cut, that's when a big move up starts or a big breakout. And so in this chart, we're looking at the 10-year yield at the top, the Fed funds rate, and then gold at the bottom. In the three lines here, the two blue lines are basically you have when the Fed did the last hike and then the cut right after. And the other line, the red line, is basically where gold bottomed. And so, yeah, the main thing here is the importance of Fed easing. Maybe the Fed cutting will also include fiscal stimulus, or the Fed's financing something. I mean, it depends on the economy and where it's at and how weak it is. But if we look at if you look at those red lines where gold bottomed and started to move, I showed the highlight there in the last 4 cycles. I mean, even in the mid-90s, gold had a little bit of a move there. Of course, it didn't last because real rates were strongly positive. There was no long-term reason to own gold, like there has been in the last 20 years with negative real rates. But nevertheless, look, you had a little bit of a move in gold there when gold was in a secular bull market. Look how it moved after the cut in 2001, the cut in 2007, that was a breakout. The cut in 2019, that was a major breakout. So if the Fed is cutting rates again in December, at the very end of this year, January, whenever, what do you think is going to happen, given where gold is? And given that gold is probably going to bottom and rebound before the cut, gold's going to break out when the Fed eases based on history. And that's not going to be, in my opinion, pick a month. Maybe it's November, December, January. Maybe it's even sooner than that. I don't think it's that far away. But, back to the other points in this chart, the blue arrow, that shows where the 10-year yield peaked. And you can see in 3 of the 4 cycles, the 10-year yield peaked before the Fed did the last hike. Although, 2 of the 4. If we look at 3 of the 4, you can see that in the last one, the last hike. No, I think I'm sorry. That line is where gold bottomed. So I got that wrong. I was originally right. So sorry about that. So again, 3 of the last 4 cycles, if you look at the blue arrow, the 10-year yield peaked before the last hike. And so maybe the 10-year yield peaked last week or whenever it was. I mean, time will tell, but if we're looking at how the equity market is selling off, it's possible that the 10-year yield has peaked. And so that would mean that the last hike is not that far away. And then given what I said in the last slide, the hike is going to come, the cut will come after that. So in summation, I know there's a lot to take in here and I'm babbling on, but the bond market and financial conditions, financial conditions first and foremost, but the bond market is the biggest part of that. And as you can see here, if history repeats itself, which I think it's going to, after the peak in the 10-year yield, at some point soon will be the Fed's last hike. And then soon after that, they do the cut, the first cut, or the first easing, if it's some different way of easing. That's my view. And with respect to when gold is going to rebound and bottom, I think when the market senses the Fed is done with the hikes, that's when gold will rebound and sustain it. Then when the Fed has to ease, that's when gold is going to get ready to make that huge breakout. So that's where we are. Let me know what you think in the comments. Follow all my work here at the channel. Make sure you subscribe, and also follow my work at TheDailyGold.com. Thank you for watching all the way to the end. I appreciate it, and I'll talk to you guys in the next video.